Moving on, Rahul Singh, the CIO of equities of Tata Asset Management, is joining us right now on the show. So, sir, firstly, to start off with, defensives and pharma are two space. So defensives, that is FMCG and pharma, are two sectors that have been buzzing of late. For FMCG, the narrative is now changing to a strong monsoon that will lead to higher rural recovery. How are you looking at the FMCG sector currently?
Yeah, you're right. I think FMCG has gone through a couple of years of volume slowdown, and now we are seeing first signs of revival in the revenue growth. It may not go up to double digits, but clearly we are seeing that the bottom has been formed and there could be some recovery. Obviously, I think in this kind of a scenario, bottom-up stock selection becomes more important, even if it's FMCG. And I think there are some companies which might be benefiting much more. There are some companies which are already feeling much more confident about that recovery compared to other companies. And all in all, I think just to take a step back, I think this is becoming a more bottom-up stock market. Whether you look at the cyclical sectors like power, defense, manufacturing, capital goods, real estate, or you look at the defensive sectors, which is IT, pharma, consumer, which have all done well since June, July. If you look at last 3 months' performance, I think the defensives have made a comeback, and now we are at a stage where that valuation of those sectors have also moved up, and therefore the bottom-up stock selection in general in the market is going to become much more important over the next 12 to 18 months.
And how are you looking at the banking sector overall? Even if you look at on a YTD basis, the Nifty Bank Index is one of the has not given much of a return when compared to the other benchmark indices. But overall, the things are looking to be turning around for the banking space. How are you looking at the banking space?
Yes, I think the good thing about banking space is that this is probably the only sector which is trading at reasonable valuations, if I can make that comment. Of course, the fundamentals will take time to improve in terms of the lag between deposit growth and loan growth. It's not the most amenable situation for margins or AUM growth. But I think given where the valuations are and given that the credit quality at least is still looking quite comfortable, even though on the unsecured side you might see some increase in the credit cost, the overall credit cost is very comfortable. So it's a question of whether you grow by 16-17% or you're growing by 12-13%. That adjustment has happened. And I think the current valuations suggest that the expectations are really low from this sector, and that's really an ideal time to be looking at this sector when the expectations are low, rather than looking at only those sectors where the expectations are very high. And as I mentioned earlier also, the expectations remain very high from some of these sectors like defense, power, capital goods, manufacturing, and real estate. So therefore, any small disappointment also can have a significant impact on valuations in some of those sectors. And it goes back to what I was saying. Now we'll have to look at more bottom-up risk assessment of stocks rather than going by simple, thematic kind of approach towards investing for the next 12 to 24 months.
I wanted to also understand what the outlook is when it comes to the entire PSU space, because at one point in the last year or so, it was the darling sector. There was a lot of attention, government impetus. But it seems like now all of that is priced in, with some of these companies as well commanding very high valuations. How are you looking at the sector?
Yeah, PSUs are a mixed bag now. I mean, we have seen PSUs across PSU banks getting re-rated. Then we saw power sector getting re-rated, and of course defense. Then we saw the financing companies getting re-rated. So we have seen, I think, major amount of re-rating which is already through. Having said that, I think PSUs in the energy space still look attractive. PSUs in the power space I would say are still reasonably or fairly valued. But some of the PSUs in defense or some of the other sectors look little rich. And therefore, as I was saying, I think this whole thematic approach towards investing that, okay, let me buy PSUs or power or defense, I think those days are coming to an end. And we'll have to be selective within PSUs, we'll have to be selective within power, we'll have to be selective within defense, and so on.
When it comes to the IT sector, that also seems to be on a turnaround. For the past couple of days, we have been seeing positive traction when it comes to the IT space. The news flows coming in from the US market also suggest that a rate cut would increase the BFSI spends, which could benefit the IT sector. How are you reading into all this?
Yes, you're right. I think one thing is clear in IT that they may not be. We are done with the downgrades. We are done with the earning downgrades, and we might be seeing the first signs of a slow and very gradual revival in demand. We are not expecting a significant revival in demand in FY26 back to double-digit kind of growth. From low single digits revenue growth, we might go to high single digits or just about double-digit growth. So it's going to be a steady sector in our view. The good part is that the worst seems to be over. The bad part, however, is that the valuations have already caught up 15-20% to reflect the first part, which is the good part. So therefore, it is a sector which is kind of hanging in balance right now. And data coming out of US, whether the slowdown is sharp, whether the BFSI sector really is able to support that kind of spending expectations which are built in, we'll have to keep watching constantly in the case of IT sector.
And I wonder what the outlook is as well when it comes to the defensive tilt in the portfolio, sticking to some of these names at a time when the market volatility is acute. Is that a strategy that's prudent?
I think so. See, just to summarize our thoughts, I think the market is going to be more balanced going forward over the next 12 to 24 months. From a very thematic kind of a market, which saw a few sectors doing well and giving significant alpha, we are in the process of markets kind of normalizing or finding a balance or going through a consolidation phase. And in that context, I think some of the defensive sectors do make sense. Pharma has been doing well and growing also and delivering on growth, most companies. The tailwinds are pretty strong for pharma and healthcare. Consumer, we are seeing early signs of revival. IT, we are already seeing that the worst is over. How big is the revival is the question mark. And as far as banking is concerned, I think valuations are extremely reasonable. And it's a question of waiting for those macro triggers to play out in banking. So these 3 or 4 sectors provide a lot of option in terms of their defensive tilt, or if the portfolio needs to be defensively tilt, and which is what has been our approach for the last 3 or 4 months.
Well, thank you, Mr. Rahul, for joining us and giving us those details and for putting things into perspective. With that, let's slip.
If you like this video, then like, share and subscribe to ET Now.